Thanks for tuning into Talking Point. I'm your host, Niraj Shah. The case for a chat today with our guest, who is the head of global markets at UBS. And therefore, while we bring in the global angle, we try and talk about some of the local factors at length with him, because he'll have both the global and the local perspective. On your screen, the case for a chat, we will talk about whether the bullish pivot from the FPIs has begun or not. The budget view, whether the spends from the government would shift or not necessarily so, and whether domestic cyclicals could actually shine in FY25 at the expense of some of the other buckets. All of that and more with a different looking Gautam Chhaochharia. He's head of global markets at UBS in our studios. Gautam, great having you. It's been a while. Thanks for joining in.
Hello, Niraj. Good to be back.
Yeah, good to have you. So, you of course been traveling, you've been looking at the world and India from a global prism as well. How does it look, the world and India within that?
So look, world, the best way to describe the world is people have been forecasting different versions of the Fed cycle, rate up, rate cut, rate hike, inflation, but largely the economy has held up globally. We have seen China digest the entire property correction. It's still growing at 4% plus, not 1-2%. So still a good enough growth rate, and even the global economy is holding up. So unless something really of a big negative happens, and we have seen some kind of a banking shock early last year in Americas, and unlike the 08, the lessons were learned, managed very, very well. We also saw something happening in the European side, etc. So all has been digested, and the global economy is holding up quite reasonably well. Again, there's various views out there what happens in 1 year, but I would say broader global picture is still supportive for India.
Okay, so in that landscape, with India doing reasonably well on the growth front, but also the tape being priced to near perfection, if you will, and the jury is split there, but be that as it may, is there room for foreign investors to make a substantial investment to Indian equities at a point of time when Indian debt has also opened its doors?
So yes and no, in a way. So let me put this in perspective. If you talk to global investors who invest in India, they have remained largely bullish for the last 5, 10, 15, 20 years. They all believe in the India growth story. It goes up and down a bit. But if you look at long history, India has remained a key overweight market for all EM benchmarked investors. The level of overweights goes up and down. Today, it's one of the lowest relative overweights. So India's weight in the benchmark has also gone up dramatically, right? And the investors have kept pace. But the active investors' overweight is one of the lowest we have seen in many, many years, partly reflecting, one, the valuations in India. They want to buy more, but in their mind, they struggle with the valuations. And secondly, attractive opportunities on a relative basis in markets like China. Like the valuations are very, very cheap. So it reflects that dichotomy in their mind as to what to do. Look, how that will change is two things. One is the point you raised in the beginning. Will India deliver growth surprise? And that's a very, very moot point which we should discuss, because markets are priced, say, 7% GDP growth. I'm just putting a number out. Street estimates are at 7% GDP growth, while markets are priced for higher GDP growth and higher earnings growth. We saw a big GDP surprise FY24. Will we see that as the beginning of a cycle where GDP surprises? That's the big debate. That's the moot point. And that's where it will drive whether the foreign investors are forced to overcome their valuation resistance and jump in a big way. The second factor, also relevant, is what's happened in the last few years. Emerging markets as an asset class have struggled.
Yes.
So it's also not just about India specifically. If emerging markets as an asset class are not getting inflows or getting in or outflows, it doesn't matter. They can't really pump in more money in India, because the investor class which are running global benchmark funds, for them to, from a global landscape, to put in money in India, that's very difficult for us to predict. That will be episodical, depending on the investor, but not broadly. Because again, you look at the global investor base, the key market for them and the key source of funding is still Americas. And that's doing well.
True.
Very well.
Selectively, but doing well, yes.
From most benchmarks, is doing well. So there's no desperation for them to chase something. So part of it is emerging markets, part of it is relative valuation, Whether they come in a big way or not will depend on the growth surprise. So my answer to that would be, in the near term, if you're expecting a big surge in foreign portfolio investment flows, may not happen in a hurry. But as growth actually surprises positively, then possibly.
What if it doesn't surprise? I mean, 7.5%, whatever the number, add whatever inflation and then a little bit of earnings growth. So people pencil in, let's say, between 13 to 15% earnings growth. Yeah. What if that is what is delivered? At the cusp of Q1, we'll get to know.
So they remain overweight. I don't see them changing their overweight stance on India.
But they don't put in fresh money to work because a lot of money is already
fresh money will be in line with either flows into EM or India's weightage in EM itself, right? Because if India keeps delivering 13-14% growth, there is more free float available.
But I thought the foreign funds were underweight India's weightage by a couple of percentage points.
Not really.
No, you don't think so?
Not really. So they are still overweight. Again, few investors might have done that tactically, but at an aggregate level, they're still overweight.
Still overweight.
But the relative overweight is one of the lowest we have seen in many, many years.
Okay.
Many, many years.
So to your mind, it is now that politics is out of the way, it is earnings delivery which will determine whether the FIs make a comeback or not.
Or comfort with the earnings delivery.
Or, perfect, comfort with the earnings delivery.
Yeah, so right now, I said, the broader street, and even investors you speak to, they're still in their mind, okay, India can grow at 7%. But can it grow at 7.5%, 8% for a longer period of time, and therefore much higher earnings growth? Because India's earnings picture compared to many other markets is not necessarily that attractive from a 1-2 year perspective. Longer term, yes, because a lot of the other economies in the emerging markets are coming off a bad cycle. So the headline earnings growth of the market is not necessarily weak versus India. So they see pockets of opportunity because again, look, most investors also have to outperform from the next 1 year perspective. So if the earnings cycle supports 15% growth in other markets, say Taiwan, it's attractive.
What do you advise then? Because the slight difference, Gautam, at least the way I see it, and I might be wrong here, but the slight difference is that unlike previous incidents pre-2020, when if there is a weak cycle or negative news, and the tape used to be hit very, very adversely, because if foreigners pull out money, then there was no support. This time around, these dips are getting bought because of the gush of local money, right? So what do you tell your global clients? Ke, bhai, wait for how long? मतलब ऐसा तो नहीं है कि you will get 20-25%, right?
No, we advise them that from a longer term perspective, it's a great market, and they agree. There's no debate on that. So they agree and they're convinced of that, and that's why they remain overweight. So I don't think they will go to an underweight position as such.
Got it, okay.
Unless there's a negative surprise. But for them to dramatically increase their overweight stance from where it is today, either EM asset class sees a lot more flows, or we see the earnings delivery.
Got it. Okay. So that's one piece, viewers, and I hope you got a good gist of how Gautam, who's now was always, but now even more so entrenched in this whole global piece, and it's great to get that view. Now, Gautam, let's talk about what will drive earnings growth. You mentioned we should talk about it. So let's talk about what could drive earnings growth over the next 12 to 24 to 36 months. In your hypothesis, is it Capex, or is it some bit of moderation in Capex because the government may be forced to shift some spends to consumption as well? Or do you think, by virtue of the RBI dividend and some others and the GST collections, it's enough to do both while maintaining the fiscal glide path?
So look, let's tackle this at a big picture. In my view, in our view, we have seen in many cycles globally and here also in India, the big earnings delta will come from sustained Capex cycle. We saw that in pre-GFC cycle, the 03 to 08 cycle. Ultimately, the Capex cycle was so strong that despite government trying to increase spending towards consumption, the fiscal deficit kept coming down. That's what the power of the cycle is. Okay? And hopefully the government sustains towards that even if they want to do more spending towards consumption, it's within those boundaries. Now, let's look at the so-called spending on consumption or trying to do more social spending. Look, the easiest way to do that is tax cuts, because that's most efficient, effective, immediate transfer of money from the government to the consumer. Immediate. Any other social scheme takes time to deliver, execute. Like even when the UPA government had brought in Narega, it took a year, 2 years for it to devise the scheme, put it on the ground, etc. Like anything you do something similar will take time. And this nuance is important because when you hear in the budget what they're doing, how much will it affect consumption near term versus longer term, how much it is political, social, this will help us, all of us in the markets, devise that. So barring any big tax breaks immediately, a lot of it will be more for political, social, and longer term action rather than immediate. And again, second part is the scale of spending. Like even Narega in the scale of spending today, for argument's sake, is a far, far smaller percentage of GDP and therefore fiscal than it was in the 2000s. Okay? So that's the second thing to remember. While Capex has gone up and is a far bigger component in terms of compared to any incremental consumption scheme. So the scale is also important, barring major tax cuts. So we should have that, we should nuance that when the budget comes out, how much it is for headline, how much it is actually constraining the space for the fiscal and therefore for Capex. The last point I would add there, look, ultimately government has been doing public Capex. And the two aspects I would highlight here. Public Capex ultimately is done to pull in private Capex. So that's far more important in my view, that at what stage the private Capex cycle actually starts happening. Because public Capex cannot go on till perpetuity in terms of Y and Y growth. They'll always spend at a particular level, but they cannot keep growing double digit for many, many years. Because at some stage it becomes difficult. The second aspect is public Capex has also been helped by stronger revenue collection in a way. Okay? And that's a virtuous cycle. We saw that in the 2000 cycle also. So as long as the GST collections you mentioned, income tax collections you mentioned, they kept keeping pace, even public Capex can keep pace. So there is a case for that virtuous cycle to happen, but things have to align. And that the missing picture in all this, if I look at from various angles, the missing picture is private Capex cycle. And that's the key thing to watch out for if I'm taking a 3-year or 5-year view. All these points which we discussed do matter for the next 3 months, 6 months, but from a 3-year perspective, for, as you said, markets are priced to perfection, the key picture is private Capex.
Gautam, I'll come to Capex at the end. I want to first try and talk about consumption and whether you believe pockets of consumption have the strength and the investor focus to shine, and whether earnings will come in as well, be it autos, be it travel, tourism, hospitality, be it staples, what have you, discretionary, non-discretionary. What are your thoughts?
So look, big picture first. You mentioned about Capex and consumption separately, but we have seen a consumption, a two-paced, the top end doing well, bottom end struggling. It also reflects the Capex cycle in a way. Because ultimately, longer term, you need Capex cycle to drive a much stronger headline GDP, and that's what flows into the bottom end under the consumption curve, beyond the goodies from the government. Ultimately, goodies from the government cannot be sustainable longer term. So that's what the missing piece is, and linkage to Capex cycle. The second part is pockets, right? So one of the pockets which our analysts have identified as something worthwhile, and they've done some extensive modeling, including sophisticated regression analysis and other markets, how these things are played out, is around air travel. And that has implications for airlines, for travel agencies, even hotels, so broader ecosystem of travel sector. And their view is the airline travel will surprise materially positively over the next 5-7 years, based on the modeling they have done. I think the numbers they have is double-digit CAGR versus the high single digits which the markets are forecasting. And that's based on the way pace of infrastructure building is happening, the connectivity, and precedents we have seen in other markets when we see this kind of pace of growth. So just the propensity to use air travel, and therefore all the supply coming in will be absorbed. I think that's one good signal of the power of this cycle beyond household incomes or lower level income level for the lower income households. So pockets like airline, hotels, leisure will keep on doing very, very well. Pockets like retail, staples will depend on how the cycle actually evolves at a broader level. So if we ask our house view for the next 6 months, 12 months, discretionary specifically, we'd prefer to be underweight from a 6-month perspective. Longer term, obviously, all of these portions of the economy should do well, but in the near term, 6 to 12 months, we are underweight, unless something changes, either Capex cycle surprises positively or there's a material government spending towards consumers.
Got it. Well, in fact, viewers, if you wonder what is it that are the nuances of the point that Gautam was mentioning on the travel piece, UBS has, it was a top brokerage note this morning on our channel, and they maintained a buy and raised the target on Indigo specifically as well, as they envisage continued strength in India's air travel demand. Mahima has more on this note as well. Mahima, good morning.
Good morning, Niraj. So UBS has maintained buy rating for Indigo, and they've raised the target price to 5,400, which was previously at 4,000. So it's an upside of almost 18%. Now, what they're saying is that they see continued strength in India's air travel demand and expect 11 to 17% CAGR in Indian air travel demand over FY30 as per their estimates. They expect Indigo's market shares in the international travel to continue basis the new additions in the airlines that they've made. They've also said that they remain constructive on Indigo's medium-term profitability driven by a highly favorable industry structure. They expect Indigo to generate 13% EBITDA CAGR over FY24 to 27 estimates. Now, short-term profitability might get impacted due to sudden rise in supply, seasonality, and sharp fuel price increases. However, any associated dip in the stock price remains an ideal buying opportunity for Indigo is what they're saying. Lastly, they're also saying that they expect Indigo's Q1 yields to be impacted considering the sharp rise in Air India and Vistara's near-term capacity, and expect a weaker Q2 on the basis of seasonality. So this is the overall summary of the UBS note on Interglobe Aviation.
Thanks, Mahima. Thanks for bringing that to us as well. So, viewers, that's the first part of consumption done. One quick follow-up there, and although you kind of briefly referred to it, but a lot of talk or chatter around if indeed there is a government support of some sort, state or center, being given out in the election seasons. There are 2-3 state elections as well, and the budget, so on and so forth. Maybe staples could make a comeback. They're not cheap. They never were. Are they attractive buys on that hypothesis, or would you rather wait for something like that to happen and then evaluate?
Look, some of them did well post the elections already, and some of them were doing well even through early part of the year, as there were some early green shoots of rural recovery. Now, again, boils down to the nuances, frankly, speculatively possibly, but boils down to the nuances of the government support, whether it's rural, it's tax cuts, where they focus their spending on.
Okay.
So I would wait for those nuances, rather than jump in, because, as I said, our strategist view is still underweight that space unless something material changes. Little bit tweaks here and there will not change things materially. But yeah, if something major happens on the support schemes or new schemes, then yes.
Okay. Now, Capex. And you mentioned the need for it, a well-established zone, right? The question is, some of the potential beneficiaries, indirect beneficiaries of a Capex cycle, the MNC Capex beneficiaries, etc., all got taken up, right, and priced massively higher. You guys came out with some notes as well there, I remember. Then my question is, if the private Capex cycle does show a broad-based evidence, Gautam, what benefits in this? Is this the same set of few names which have got the moat around this whole business, or is it some of the Indian players? Is it the ancillaries? How do you play this theme now?
Look, broader Capex becomes actually broader segments for investors to play in a way. Because broad-based Capex cycle means it's no longer limited to, say, automation / where the MNCs did well, or just the power sector where there was a cyclical demand-supply shortage. But it becomes broader set of things. And again, if it coincides well with a meaningful supply chain relocation, then even the industrial equipment supply chain players, they all could be beneficiaries of that. Now, traditionally, if you look at the last big Capex cycle in the 2000s, that was more infra, power and telecom and energy, a lot of that. And that matters it's a nuance, because they are typically more capital intensive. So when we define Capex cycle in dollar terms or rupee terms, how much money you spend, those sectors are more capital intensive versus setting up an automobile plant. Okay. So this cycle versus that cycle, that's a nuance to keep in mind. But this cycle, unlike the last cycle, also should have potentially more supply chain driven Capex happening. So more scattered, more number of players trying to step up capacity and adding up possibly. But these are the two things to keep in mind. If we start seeing Capex spending picking up in infra energy also, then it could become very, very strong, similar to what happened in that decade. But otherwise, for it to become a proper private Capex cycle, this needs to be more broader based than what we saw that time. Because it's difficult for us to argue today that you'll see a big private Capex cycle happening in power. We all remember the big surge towards setting up private power plants last time. It's difficult to replicate that because the context was very different. Similarly on energy.
But there's a lot of talk of,
Yeah,
just coming in. There's a lot of talk of how non-thermal, non-conventional,
Exactly.
but the wind and the solar Capex will happen.
Will happen. So again, that's where the supply chain, etc., comes in. Because if it coincides with a proper supply chain set up in India, then that cycle is meaningful. Because if you look at thermal power generation, India has local supply, BHEL, etc. So the Capex is much more local economy supportive. While for solar, even wind, it's much more import intensive. So for it to really drive the economy, the supply chain has to also.
Do you see that happening? Because there seems to be a focus on wind and solar in a big way, right?
Yeah.
Do you
So
see
there's
the
talks
supply
about
chain
that.
getting built out?
There is clear talks of that. But again, this is more global and not just Indian. Because we've seen even the Western world trying to create barriers around the renewable energy side because China is very, very competitive. So what happens globally will also, to some extent, influence India indirectly. Because India's ability to set up local at scale just for local markets, is it going to be enough? Or will the policymakers have enough tariff barriers to support that scale up? So there are two moving parts. Tariff barriers to support local ecosystem to scale up.
Got it.
Second part is, if the Western world is also trying to protect itself, will that opportunity open up for the Indian suppliers?
So simplify this for us as we wrap up. How do you play this then? As things stand, you build out a hypothesis, you bet on those stocks. What are you betting on?
So look, as of now, we are overweight industrials and utilities from a 6-12 month perspective, because there's no reason to believe that the course will change negatively at all. Okay? If the cycle continues, and if whether it's Capex, private Capex cycle, GDP, etc., plays up, this sector will keep throwing earnings surprises. Okay? Like our analysts typically forget the stocks, but generally speaking, his estimates are definitely higher versus the street. And this is without building a proper private Capex cycle. If that cycle happens, this will be even broader. So I would still go for being positioned for that, for specifically if you're thinking about a 3-year cycle. That's where you can still be making alpha compared to markets.
And that, sorry, just 30 seconds, but the ancillaries, I mean, the wire companies, cable companies, etc., they all come into the picture.
They're all the broader sector, because
everything
everything benefits from that.
Yeah, got it.
Absolutely.
Great. Gautam, so good talking to you. Thanks. Thanks for joining in the studios, more importantly. Great seeing you after such a long time. And all the best with your new stint in India, if you will.
Thank you, Neil. Thank you.
And viewers, thanks for tuning into this edition of The Talking Point.